There are a variety of alternatives available to an investor trying to maximize returns. Understanding your objectives and how each form of investment relates to them is the key to choosing the best one. Knowing the benefits you gain being a small investor will help you use them to your advantage and increase your earnings. You'll discover in this video how a variety of investment strategies that have the potential to yield large returns might help modest investors increase their returns. Let's start with the first on this list is fractional shares. A single share of a stock with a strong return on investment, like Tesla or Amazon, may cost tens of thousands of dollars. Most investors will find that to be far too pricey. With fractional shares, however, small investors can purchase a portion of a company's stock for just $1. When someone purchases a fractional share, they are just purchasing a portion of a full share. For new and small investors that are lacking a lot of cash on hand, this makes things more accessible and affordable. However, not every online broker offers fractional shares. For instance, allow tiny investors to purchase fractional shares for as little as 1 out of 1 million of each share using the free trading software Robinhood. There are no charges, and all deals are commission-free. The investing software, however, is entirely self-directed and ideally suited for novice and small investors having at least some prior expertise. Particularly investors with limited extra funds who are keen on purchasing well-liked, high-value stocks. The next on this list is mutual funds and ETFs. For small investors, mutual funds and exchange-traded funds are excellent tools for portfolio diversification and risk management. They both let clients to invest in a variety of businesses and industries and are expertly managed by fund managers. Small investors can use robotic advisors as well as self-directed broker accounts to make investments in mutual funds and ETFs. For example, M1 Finance is most appropriate for intermediate investors. Small investors create completely unique portfolios, referred to as pies, by selecting their own equities and ETFs. The program automatically manages the user's portfolio and purchases stocks for them based on their pies. Particularly modest investors with some prior investing expertise and investors looking for a trustworthy solution to diversify their financial investments. The next option is Dividend Reinvestment Plan, DRIPs. Small investors can get started with DRIPs with just one share. The profits of some large corporations are given as dividends to the shareholders. By automatically purchasing more whole or shares and fractions of stock from the same company, small investors can reinvest dividends. As a result, investors' money might grow quicker thanks to compound interest. For instance, if small investors purchase one share this year and then 2 shares later, their dividends in year 2 will be higher than their payouts in year 1. If a stock increases the amount of its dividend from $1 to $1.10 the following year, their earning potential improves. Just cling on to the stock because they have nothing more to do. Many internet brokers provide investors with free dividend reinvestment schemes. It's intended mostly for small investors who have strong feelings about a certain stock and are okay riding out the market. The next is P2P Lending. Small investors make money by granting funds as an investment while earning interest from the borrower rather than lending a neighbor for free. For instance, Johnson, $100 without charging interest. Peer-to-peer, P2P, lending operates in this manner. People who might not be able to get money from traditional lenders can get unsecured personal loans from small investors. If a borrower fails to repay the loan with interest, investors run the risk of losing their principal. Therefore, they make sure the loan has interest attached. P2P lending systems will divide small investors' investments into little investments of $25 or $50 to a bunch of different people in order to reduce the danger of someone defaulting on their repayment. Also check out real estate investment. Did you know that on average, during the past 30 years, real estate investing has outperformed stocks? Real money can be made by purchasing and selling residencies. So purchasing real estate will be another example of a tiny investment getting high profits. They can earn by selling the property they purchase in a location that is just starting to develop and thrive once its value increases. They might also make money from the business if they open it on their property. And third, if they own an apartment, they stand to gain not just from the property's appreciation over time, but also from the ability to rent the unit to tenants, which allows them to supplement their income. Another area is money market funds. Compared to savings and checking accounts, money market funds are investments with minimal risk that offer high dividend yields. Money market funds are also safer than bond or stock investments because their value doesn't change significantly day to day, reducing the risk of principal loss for small investors. Money market funds make investments in short-term financial securities like commercial paper, treasury bills, and certificates of deposits, CDs. Because it gives a return comparable to that which small investors may anticipate from a savings account at their bank or checking account, this sort of investment is referred to as a cash equivalent. Also, another way is high-yield saving account. Compared to traditional banks, online banks offer interest rates that are up to 20 times greater. Additionally, as long as a small investor chooses an FDIC-insured bank, their investments are fully risk-free. The government will reimburse the investor for the amount in their account, up to $250,000, regardless of whether the bank defaults. Small investors have constant access to their funds for a variety of purposes, including an emergency fund and home down payment. This is advantageous for small investors looking for a quick investment to cover a particular expense. It's also advantageous for investors who locate a credit union or bank with a competitive rate. Next is government bond funds. Government bond funds are additional low-risk, high-return investments that let small investors purchase bonds issued by the government. Bonds are just a form of debt or a loan, so when small investors purchase them from a company or the central bank of another country, such as the US or China, they are effectively lending the company the money for the specified length of time. Small investors will receive payments at regular intervals until maturity, at which point they will receive all of their initial investment, along with any interest that has accrued, and with a guarantee not to remove it until later in life. Another amazing way small investors earn high returns is dividend-paying stocks. Stocks that pay dividends are an excellent approach for younger investors to broaden their holdings and generate passive income. Additionally, they are investments with little risk that can offer investors substantial profits over time. Here's why small investors could think about including dividend equities in their portfolios. 1. Dividends are sums of money given by the corporation in which a stockholder owns stock to shareholders, also known as investors. Dividends are frequently distributed by companies, and they are normally much more reliable than other types of investment income, like interest. 2. If kept for more than a year, dividends are subject to tax at a rate that is less than capital gains. Because of this, they are a desirable substitute for accounts that yield interest or bond yields for investors seeking large returns from low-risk assets. 3. Small investors may reinvest the dividends they receive back into the business, and by doing so over time, they can even increase their share in the company. The last but not the least is another type known as TIPS, Treasury Inflation Protected Securities. Treasury Inflation Protected Securities provide small investors with high returns with no risk. They are safe as well as a low danger of failure or bankruptcy because the US government is behind them. As a result, investors will be able to sustain their purchasing power regardless of how expensive items become, because these securities also feature an inflation modifier that enables small investors' money to keep up with the increasing cost of living. TIPS will keep on paying interest on top of their principal amount for as long as there is inflation and consumers are still utilizing dollars to make purchases. This means that regardless of whether prices increase by 10% the following year, the money of small investors will still be worth more since it keeps pace with inflation. That's it for today's video, and don't forget to comment below with your feedback. If you find this video helpful, hit the notification button, like and subscribe to our channel.